Hello, my dear buddies. How are you doing? So, guys, lecture number 87 today, and we shall start off with a very, very interesting topic, very important topic, a very easy topic called MAT. So, generally, guys, in this question, they will definitely ask a question in the examination, very important. People generally have this notion that MAT is very difficult, etc. It's not like that. It's just that if you understand the logic and the concept of everything, no, it becomes very simple. So guys, just think about it. If my, as per Companies Act, right? As per Companies Act, I will obviously calculate something called as the book profit. So as per Companies Act, I will calculate the book profit. But as per Income Tax Act, I will somehow make the taxation nil. By the way, the MAT topic in our notes is in page S.1, S.1, S.2, like that it goes. Please see module number 1, minimum alternate tax, MAT. 115 JB, that's how it is. So tax rate, generally they'll make it nil. How I'll make it nil? One, by claiming the depreciation, you have additional depreciation, etc. Then we have a lot of exemptions, section 10 exemptions, and then of course we have ATIA, ITIB, all these deductions, etc. Exemption deductions, ATC deductions, all your 80 series, 10 series, 10 AA series, whatever the case may be. So because of which many companies were claiming the book profit to be high, and of course the tax profit when you compute using the income tax laws, they used to make it almost nil. And the master manipulator, or more than manipulator, I would say, when manipulator is a wrong word, but what I would say is the master income tax planner, where there was a thin line of difference between tax planning and tax saving, tax avoidance, so to speak. Tax avoidance and tax planning, there's a very thin line of difference. Tax evasion is totally where you don't even offer your money to tax. That's a different thing. I'm not talking about tax evasion, but I'm talking about tax avoidance and tax planning. The master of tax evasion and tax planning, tax avoidance and tax planning, was none other than Dhirubhai Ambani. Because of Dhirubhai Ambani, so many laws have changed, guys, actually. In fact, because at his behest, many laws were also changed in his favor. I usually tell it in, our company law. He changed a section called intercorporate loans. There was a section called 372 capital A in the old Companies Act that he changed because he wanted the DuPont deal. So all that I discuss in Companies Act anyway. So here also many changes he did. Master tax planner, so to speak. So there was this, generally there was this minister called VP Singh. Used to be a minister. He was a finance minister in 1986. So 90% of the changes he made during the 1986 budget, of course we were not born, but then if you just read the history, you'll know that he did it only for what? To ensure that Dhirubhai Ambani it's against Dhirubhai Ambani. Basically, he had a huge problem, public tiff with Dhirubhai Ambani. To just do a simple Google search, VP Singh and Dhirubhai Ambani, or VP Singh versus Dhirubhai Ambani, you will see the full history as to what happened, why they were always fighting, all those things. So he introduced actually a concept called minimum alternate tax. Imagine, VP Singh way back in 1986. He said, Companies Act, you are showing super profit. Here you are showing 5,000 crore profit. Here you are showing nil. I'm missing out on this. So he said, you should pay tax on either of the two. Either this, if this is nil, or here you should pay. So introduced in 1986, and Dhirubhai Ambani coolly ensured that he will not pay 1 rupee also even under the new regime of MAT because of his tax planning techniques. Then in 1987, superb amendments VP Singh made, still Dhirubhai Ambani won. In 1988, still Dhirubhai Ambani won. And in 1989, VP Singh also was thrown out. MAT also was abolished. MAT also was abolished. Right? So it was in the year, if I'm not wrong, 1997, when Lungi Man, Chidu, was the guy who said that Ambani has been defeating tax, etc. So actually Dhirubhai Ambani passed away in the year 2022. This was his last final years. He said, I will draft in such a way that nobody can change it. Chidambaram is a very smart guy, guys. He is a, lawyer who was also practicing. Of course, he was, honorary professor of Harvard and Oxford as well. So when this fellow said, Lungi man, that I'm going to change the way things are done here, people thought, okay, nobody can touch him. Dhirubhai Ambani took it up as a challenge. And during his last few years of his life, still Dhirubhai Ambani won. Though whatever Chidambaram made all changes, he himself has drafted the law. So MAT has himself been drafted by the man himself, P. Chidambaram. Right? So this is the concept of MAT, guys. Minimum alternate tax. Minimum alternate tax. So we'll dive into it. Basically, it starts with 115 JB. Now still MAT is very much applicable, and Dhirubhai Ambani has still, managed in 1997 only to change it. It went up to the Supreme Court. Supreme Court also agreed nothing can be done. So Ambani, won that particular, entire tax planning thing. That still can be done, but only in big companies. I'll tell you all those things, what happened and all that. Don't worry. Right? So on that note, let us now dive into, what do you say, minimum alternate tax concept. Let's come to the notes. See, applicability, guys, it is for all companies SSE, all company SSEs. On companies only have to pay. Objective, as I told you, to ensure, to ensure collection of minimum amount of tax from companies which have book profits but very less taxable income. Provisions of Section 115 JB have been enacted to restrict availability of certain exemptions, incentives and deductions to companies so as to collect minimum amount of tax at least. So two parallel computations have to be made, my dear friends. Two parallel computations. One is income tax as per normal income tax provisions. Second one, 115% of book profits. So they are trying to tell, bro, you pay this one, okay. Or if this is not even there, at least you pay 15% of book profits. At least you pay 15% of book profits. So 15% of book profits will be the tax. So either, guys, A or B, whichever is higher. A is as per the income tax provisions normal. Along with that, you should what? Add surcharge. And what is the surcharge? You know that this is the surcharge. In case of, MAT provisions, 1 crore to less than 10 crore, domestic company 7%, foreign company 2%. Income more than 10 crore, domestic company 12%, foreign company 5%. And of course, after that, health and education cess. But there's a small relaxation for what? IFSC, International Financial Services Center, which derives its income solely in convertible foreign exchange. MAT is chargeable instead of 15%, it is 9%. It is 9%. So guys, 115 JB, applicability provisions, etc. So important, of course. So this particular company section, will not apply to certain companies, will apply to certain companies, and all that we need to understand. So basically, right, we need to see where it applies, where it doesn't apply, and other things, so as to understand the entire scheme of things. Now, if you see, let us see, 115 JB is the MAT provisions. We'll take you to the Bear Act. See, notwithstanding anything in any other provision of the Act, there was an income tax Supreme Court case law which said, notwithstanding anything contained means it overrides the entire income tax law. Wrong. Notwithstanding anything contained in any other provisions means it overrides only the conflicting provisions of law, which means, will penalty apply? Yes. Will advance tax 234 ABC apply? Yes. Right? Only the conflicting provisions will not apply. What? Normal tax provisions will not apply. This will apply. Then there are some additions, deletions. We'll have to see. Where in the case of an SSE being a company, will it apply to foreign company, domestic company, all companies? 100% it will apply to all companies, guys, because it uses the word a. It uses the word a. Being the income tax payable on the tax as computed so and so in the same year is less than 18.5% of its book profit. Now this one, 18%, it became 18.5%, and that, if you see, from April 1st 2020. So as of now, guys, it is 15%. So here in our notes you have written, no, whatever this is, it was 18.5, now it is 15, is correct. They have reduced it. So a company will include foreign company also, basically every company, guys. As of now, a company, all companies are included, is what you need to see. And of course, I told you already the, what do you say, tax on total income, how much will be. Then book profits also you need to see, whichever is, higher is what you need to understand. Very simple. So one book profit is so much amount. To that you add surcharge and secondary cess. Similarly with tax normal also you do the same thing. Then whichever is higher is what you need to see. So A or B, whichever is higher. For everything you have to add surcharge, because surcharge cess will be the same anyway. Compare the two and see whichever is higher. Very, very simple. Now, here 115 JB2 here. Every SEC being a company which has prepared what? As per clause B. One second, I'll just show this. So this part, I'll again explain what happened. Again, Ambani guys, Dhirubhai Ambani, smart guy. So Dhirubhai Ambani, what did he do? First part, before JB, 115 JB was inserted. Okay, no tension. But in this, what happened? I prepared two balance sheets. One, Companies Act to be given to the shareholders. Generally, guys, how it works is, just for your understanding, Companies Act provisions, the accounts will be prepared by the management. This is books of accounts. I'm talking about Companies Act. And the financial statements will be prepared under section 129. Right? And then these financial statements will be approved by the board of directors, right? And they will authenticate. Authenticate means what? They will sign. After signing, it will be sent for the auditor report. Sent to auditor. Then board will give the board report. After seeing the auditor's report, board also will give the board report. After that, under section 136, all these documents, that is financial statements, notes to accounts, then auditor's report, board's report, under section 136 will be circulated to all shareholders. Circulated to all shareholders. And so once it is circulated, under 102 of that AGM will happen, where they will consider the accounts. After considering the accounts, they will adopt the accounts. After adopting the accounts, they will file the entire thing. Your annual accounts will be filed under that, section 137. 137, they will file in AOC 4. Annual return also will be filed under MGT 7. This is the entire scheme of things. Now, where we will come in here, if you see, for this, for laying before the AGM in front of the shareholders, because I want them to adopt the balance sheet P&L, what will I do? Companies Act, under Companies Act, I will prepare a different balance sheet where depreciation I will show 10k crore and net profit I will show 201 crore. Then for tax purposes, I can increase the rate because depreciation as per Companies Act is the bare minimum that they have given. So here I can increase the rate to, okay, here let me make it 20k. Net profit is 20k crore, depreciation is 10k crore. Here depreciation I can make it 30k crore and this I can make it nil. So one balance sheet for the Companies Act and one balance sheet Companies Act purposes, from the Companies Act purposes for tax purposes, where I'll say, sir, this is for the Companies Act, laying before the shareholders. One more is for the tax purposes, I have computed higher rate. Who are you to tell? This issue went to court in many cases. Court said nowhere it has been written that for income tax purposes I cannot make a separate balance sheet and P&L. So the government lost the case. After they lost the case is one part of the story. Second part of the story, for example, electricity company, insurance company, banking company, you would have done in CA Inter Group 2. Electricity company, insurance company, banking company, these companies will tell that, bro, I have not, what do you say? Companies Act will not apply to me only. So you are telling book profit. Book profit means book profit as per Companies Act. Companies Act will not apply because I will prepare the books based on Electricity Act, Insurance Act, what to do. So these two were the dilemma. One was normal companies which are giving two accounts. One more is electricity company, etc. So will it apply or not is the question. So Chidambaram again inserted 115 JB2 saying that, okay bro, you got me. I understand. You please prepare two. I am also telling please prepare two balance sheet P&L. No problem. One for income tax, one for this thing. But accounting policy must be changed. Same. Accounting policy means what? Accounting principle and the method of applying that principle. Accounting principle is depreciation. Method of applying the principle, WDV, SLM, whatever you're doing. Rates, everything should be same. Right? Accounting standards used for preparing such things must be same. Accounting standards for one this separate accounting standard there, no. Methods and rates must be same. So basically, Lungi man created a level playing field saying that you prepare whatever you want, but the policies etc. base should be same. Then I will accept. Then for insurance company, banking company, okay, book profit for you may not be Companies Act purposes. So book profit for you will be your own act purposes, which means prepare the balance sheet and P&L as per Electricity Act, Insurance Act and Banking Act. In that only I will charge, no problem. I will charge as per that only. MAT. MAT is tax on normal provisions, or 15% on those provisions, whichever on the book profit, whichever is higher. Book profit I will deem it to be banking only, no problem. Right? No problem. Like company would have amortized the expenditure on voluntary retirement scheme over 5 years in the what do you say, Companies Act balance sheet P&L to be shown to the shareholders. But for tax purposes, that full amount they would have done it that year only. There is no hard and fast rule. Policy would be different. No, policy would be different. In one case, they would have used like the old AS11. The other case, they would not have used that. Policy would be different. Policy. Higher rates I would have chosen for income tax purposes as per Companies Act only, because Companies Act gives the useful life, etc. But you can increase or decrease it. At old, I mean, before 2013, you could have, in 2013, 2015 also, they would have increased and decreased and all. The number of rates of the depreciation rates, if you have taken a proper, what do you say, written representation from management, also experts' opinion. If you have taken a valuer's opinion about increasing the useful life, you could have done that. All these golmaal people were doing. So now level playing field as per 115 JB2. Okay, do you bro? You do two accounts, bro. No problem. One for income tax purposes, one for company. No problem, bro. But bro, maintain the accounting policy, maintain the method of accounting, maintain the accounting standards, then no problem. Second part, you electricity company, insurance company fellows, do it. I'll do it as per your books only. I'm not going to change, right? Check it out. Same. In accordance with provisions of Schedule 3, you follow as per Schedule 3. And for other companies who are following under second proviso 129 is nothing but banking company, insurance company, etc. You please do it as per the act governing such company, no problem. By Banking Act, Insurance Act, you do, no problem. And when preparing the annual accounts, ensure that the accounting policies are the same, accounting standards are the same, methods and rules, rates used are the same, no problem. Big deal. Shall correspond to all those things. So if you see, come here. Here. That is one part of the story. Then these are all additions, deletions, etc. Then you see this also. Provisions of this section shall not be applicable and shall be deemed never to be applicable for what? SSC is a resident of the country or a specified territory. Remember international taxation? Specified territory. That is your Hong Kong, Macau, etc. With which India has an agreement under 1998. If DTA comes, then provisions of this section will not apply. right? And there may be some countries which doesn't even require any registration under Companies Act. So it is a completely foreign country, foreign company does not require any registration under Companies Act. If Tesla, a foreign company, opens a showroom or rather, branch in India, that Indian company requires registration, but Tesla, for that matter, doesn't require any registration as such. So both combined, check this out. Yes. Section 115 JB MAT shall not apply to foreign company when foreign company is a resident of a country with which India has entered into an agreement under 91 or 90A and which does not have a permanent establishment in India. So my Tesla example was 100% wrong. Why? Tesla Incorporated has a permanent establishment in India. Alibaba does not have a permanent establishment in India. So if Alibaba company, foreign company, resident of a country, China, in which India has an agreement, DTA, then the provisions of MAT will not apply to them because it do not have a permanent establishment, whereas Tesla has a PE in India through a subsidiary company. Foreign company is a resident of a country with which India has not entered into any agreement and is not required to seek any registration under any law relating to companies in India. Not required. Random company, not required to have any deal with India. Open any company in its name in India. A foreign company has a permanent business in India, but its total income comprises solely, most important. Under what? 44B, shipping. 44BB, mineral oil. BBA, aircraft. BBB, civil construction, etc. Guys, solely. This company has shipping business plus income from other sources. MAT will apply. Important MCQ. One shipping business company also has other business, side business. It will apply. Shipping companies got under 115 VO. Life insurance companies, separate act of parliament. Domestic companies which opt for, this one, see, special rate of tax under 115 BAA, BAB. If you opt for special rate of taxation under 115 BAA, BAB, then domestic companies MAT will not apply. Similarly, Section 8 companies is for not for profit. Section 8 companies of Companies Act is a company which was not for profit. That's why for them also this section will not apply because it's principle of mutuality. Every company shall prepare the statement in Schedule 3. If you cannot follow, then follow the respective law, it says. Then as I told you, accounting policy, standards, methods, everything shall be the same. This requirement will apply even if a company adopts a year which is different from the previous year under the Income Tax Act. Income Tax Act is April to March. Even if you follow January to December, which is possible in some cases in Companies Act, here also you can do the needful. The following items shall be added back to the profits. These are the adjustments. Anyway, ICDS will not have any impact on computation of profit. ICDS will not have any major impact as such. So one by one we need to do this, guys. These adjustments are very, very important. So basically you need to add back from whatever the profit that you get, net profit. From that you need to add certain items, subtract certain items to arrive at the book profit. Right? And the net profit, whatever you have already derived, add the following items. So whatever the net profit means, as per books, whatever you have made some adjustments. Add certain things, subtract certain things. And once you add and subtract, final thing will come. Based on this only questions will come. What should be added, what should be subtracted, etc. So our entire discussion, my dear friends, will be based on what will be added, what will be subtracted, like that. So let's see all the additions, my dear friends. So here, all these are additions and deletions, or additions and subtractions, so to speak. First one. See, so many are there. One by one, you have to see. For the purpose of the section, this section 115 JB, book profit means the profit as shown in the statement of P&L for the relevant previous year as increased by, means like this is like a disallowance. This is like a disallowance as increased by. First one, amount of income tax paid or payable and the provision thereof. Paid and payable and the provision thereof. Right? And they have added an explanation later. 2008. 2001, this, 1997, this was introduced by Chidambaram. He drafted it. Again, people were scamming. I'll tell you this. Explanation 2. We'll see one part. All these things we need to check coolly, no problem. If any amount referred to in clauses 8 to I is debited to the statement of P&L account, then I have to add back. Please remember, I'll write down here, any amount debited to A to I should be added back, or any amount referred to in clause J which is not credited should be added back. I'll tell you everything, guys, don't worry. I repeat, I'll write down here. Items A to K, if debited to P&L account, to be added back. Then item number J, clause J, which is not credited to P&L account, should be added back. Which is not credited to P&L account to be added back. And any item which is credited to P&L account, this should be reduced. These are all items credited to P&L account. Right? This is from item number, you see, 1. 2, 2A, 2B, 2, 3, 2C, like that it will go. 4 to 5, like that till 7. 1 to 7, 1 to 8. 7, 8, 1 to 8. Then 1 to 8 items, they are already credited to P&L account. That has to be reduced. So in today's class, we'll have to discuss all these three, guys. A to K, if debited in the P&L account, add back. J, if it is not credited to P&L account, add back. I to 1 to 7, 1 to 8, credited to P&L account, has to be reduced. Coolly, one by one, we'll go. No tension, okay? Guys, as I told you, previous classes where there was no need for me to go slow, I have gone fast. International taxation, first few classes, out of 13 classes, first 10 classes were extremely in-depth. Last 3 classes were time pass. There is a reason for all of that. If you sit and study in-depth everything, then you will not remember everything. So we have to balance it out. Math is important, right? And we cannot just, this is the add, subtract. No mugging up at all. It should be coolly, we have to study what all is there with understanding everything. So as you know, in our entire sessions, we have done wherever in-depth is needed, we have gone crazily in-depth. Wherever it's not needed, we have done normally. Wherever full time pass, fast, we have gone. So this is the balanced way to study. Otherwise, you will have so many subjects to study. How will you study, guys? Think about it, right? Let's see one by one coolly, okay? So guys, I repeat, it should always be debited. If it is debited, then it should be added back, right? Which means if it is debited in the P&L account shown as an expense, the government didn't want the expense to continue, so I'm adding it back. One by one we'll see. A. Then I'll show where is in the notes. This we are doing Where Act analysis. Come on, one by one. A. Amount of income tax paid or payable and the provision thereof. Amount of income tax paid or payable and the provision thereof. So, first is income tax. So basically, income tax payable even in the normal income tax provisions, I will add back, or the provision thereof. For example, provision for tax is 60 crore. Net profit 100 crore. Correct provision, later they'll give in the exam, correct provision is 80 crore. You will add back 60 crore or 80 crore. Guys, as we have seen already, whatever has been debited. What is debited? 60 crore. So please add back 60 crore and not 80 crore. MCQ or questions adjustment, this will come like this. Second part of the story is interest on income tax. Interest on income tax, what should I add or not add? Whatever interest I've paid on income tax, 234 ABC and all those things. Generally, it is, the income tax, it is either, even if I debit it, basically it is penal in nature. So what many courts, one Supreme Court decision, it said that interest on income tax not to be added. This was not liked by the government, so this Supreme Court decision was nullified by insertion of explanation 2. There. For the purpose of clause A of explanation 1, the amount of income tax shall include any tax on distributed profits under 1150 and distributed under 115 or interest charge under this act, surcharge, education cess, secondary assess, everything to be added back. When I say income tax includes your dividend distribution tax, domestic companies, interest charge, 234 ABC, surcharge, education cess, secondary higher education cess, everything to be added back, my dear friends. No mercy. Everything to be added back. So if you see, point number 1, I've added it, everything here only makes easy. Interest, surcharge, education cess, everything. We'll see the examples here. So if you see, come to page S6. Income tax and interest disallowed under normal provisions, here also added back. It's like disallowing only. Penalty, both cases, when here it's disallowed, here penalty, guys, it is allowed, not to be added back. Did you see anything called penalty there? No, only interest. 234E fees, here it is disallowed, here not to be added back. These are important areas. GST, allowed subject to 43B, here also not to be added back. Other things we'll see. right? Interest payable under any other act shall not be added back while computing the profits. Guys, income tax includes interest paid under the act. So I would say this is again an MCQ question. Interest under other act not added back while computing the book profits, which means they are allowed. They are allowed. Similarly, security transaction tax also allowed. Commodities transaction tax also allowed. All these are allowed, no problem. Next B. Amount carried to any reserve by whatever name called, other than reserved for shipping business. Apart from shipping business, any amount carried to any reserves by whatever name called also should be added back. That also should be added back. If you see here, transfer to reserves. But before that, what about provision for deferred tax? Under normal income tax provisions, it will be disallowed. Under MAT, Supreme Court said not to be added. Government did not like it. It was also nullified. Years later, if you credit it back, provision for deferred tax, if you credit it back a couple of years later, saying that this provision, I'm going to bring it back into books here, this also has to be subtracted. Here. Point number H. Amount of, this was again to nullify the decision. In 2008, they made it. Amount of deferred tax and provision therefore. H. So since it's linked to, tax, I'm just making it that here also is here. In our notes, you can mark this. Sorry. Deferred tax and provision for deferred tax. Similarly, later, if some other day they will add back, they will credit the deferred tax, then also I have to subtract it, obviously, here. If credited to P&L account, I have to reduce it. Very simple. Got it, guys? Second one now. Transfer to reserve by whatever name called. Transfer to reserve by whatever name called. Transfer to reserve by whatever name called. So if the net profit carried forward is 100 crore, net profit brought down is 100 crore, general reserve is 15 crore, net profit after that is 85 crore. I should add back 15 to 85 obviously and not 100. Goes without saying. Correct? It should be added like that. It is any transfer, even if it is a transfer as per the directions of the RBI also, it has to be added back. Any reserve, it has to be added back. Any reserve, transfer to general reserve, transfer as per RBI direction, even reserve created under 10AA, everything to be added back. No mercy. Transfer to reserves by whatever name called. We'll see these examples later. See here. It is allowed subject to 3618 here added back. Any type of reserve, please add back. Normal reserve, please add back. I'm doing page S7. Next, point number C. Provision for unascertained contingent liabilities. Here you see dialogue how it is. Amount or amounts set aside for provisions made for meeting liabilities other than ascertained, basically for unascertained liabilities. Unascertained liabilities. So, if you make provision for salary, for example, March month, I will make provision for salary, March month salary. As per MAT, what to do, and as per Income Tax Act, what to do. Guys, since it is an ascertained liability, both it will be allowed, added, not added back. If I make an ad hoc gratuity provisions, so here it is disallowed, means added back. But if it is as per actuarial valuation, which means it is ascertained, actuarial valuation, add back, ascertained. I'm sorry, here you will not add. Why? What is to be added back? Only unascertained. Here there is no addition. As per Income Tax Act, you will add back, obviously, because it's an actuarial valuation, gratuity valuation. Provision for leave encashment. Assume it is scientific in nature. Scientific in nature. Not added. But here it should be added. And it's allowed to some extent. I can say 43B. Allowed under 43B. I'll give you a list later. Any warranty, if there's any warranty as such. Any warranty? There was this Rotork Controls Supreme Court decision, and for this ad hoc, provision for leave encashment, sorry, we had Bharat Earth Movers case law. These are all case law decisions. No need to remember the name. Rotork Controls India. Rotork Controls said both not to be taken into account. They are all unascertained liabilities, which means it has to be added back. Anyway, I'll give you just, I wrote down here, here I've given, check it out here. Note number 1, you see. Here. Provisions made as per a scientific basis or actual valuation shall not be added back while calculating book profits. Why? Because they are scientifically generated. Correct. So provision for warranty, contingency, loss are all unascertained. But provision for warranty, if it is scientific basis, then it is allowed. That is what Rotok said. So just keep in your mind, anything which is scientific in nature will not be added back while computing MAT. But whether scientific or not, generally it will be disallowed under Income Tax Act. Some cases it will be allowed as per 43B. 43B already discussed. This is what you need to keep in your mind. That's all. Any ad hoc stuff, add back. Scientific stuff, don't add back as far as MAT is concerned. Got it, guys? Alright, buddies. So we were discussing the provisions, right? So as I told you, anything which is ascertainable, it is okay. Unascertainable only, it should be added as discussed. Now, one more litigation happened. This was in HCL Comnet system. Whatever I am writing, no need of remembering the name and all those things, no problem. This was a Supreme Court judgment in 2008, whereby there was a provision for bad debts. Right? It was obviously disallowed under 36(1)(7), disallowed. But in the book profit, provision for bad debts is allowed because it was not an unascertained liability. Where is the liability for provision for bad debt? Supreme Court said it is not an unascertained liability. Then, is it a transfer to reserve? It was not a transfer to reserve also. So they said it should not be added back. Similarly, if there is any diminution in the value of assets with respect to other things as well, AS 13, AS 28, diminution in the value of assets, any value of any investment as such. So that also obviously should be added back as per income tax provisions, but it is neither an unascertained liability nor is it a reserve. So this was not added as per MAT. Created crazy litigation, but eventually the SSC won, especially in HCL Comnet system. To nullify that particular provision, there you go. Provision for diminution in the value of any asset was added. Right? So if you see here, the amount set aside as provision for diminution in the value of any asset. The value of any asset that was added. So if you see any asset will include debtors also, no? So if you see note number 4. See, provision for diminution in the value of any asset includes provision for bad debts, provision for non-performing asset. Right, that is the next point, guys. So that is the scene. So I'm just seeing from a particular standpoint, we are checking it. Yeah. Next, other 2 points are simple. This holding companies, no. Subsidiary companies, if they show their losses, that's okay. But holding companies, since they hold 100%, 56, 60%, 70%, they were also claiming provision for losses of subsidiary companies. Provision for losses of subsidiary companies obviously is wrong, because holding company cannot claim any expenditure for subsidiary companies' expenses. Right. So if you see, that also has to be added back. It's a simple provision. Check here. Yeah. Similarly, dividend also, whether it is paid or proposed, dividend, whether it's paid or proposed, both should be added back, because dividend is, not allowed, so it has to be added back. Provision for losses of subsidiary companies, that also has to be added back, my dear friends. Both should be added back. Dividend, it is generally proposed by the board of directors and it is declared by the shareholders. So if you remember earlier, the company used to pay something called as dividend distribution tax, and then it used to be exempt in the hands of the shareholders. But now, as you know, dividend taxation is there. Shareholders have to pay anyway. But nevertheless, dividend paid or proposed to be paid has to be added back as far as MAT provisions are concerned. Very, very simple. So this was one part of the deal. Next, let us see what all is there. Also, in this transfers of transfer to reserves, etc., you can just write down excess provision also has to be added back. For example, normal provision you make 10, but then later you find out that it should have been 8. The excess provision 2, that also has to be added back. That is, if they give an adjustment saying excess provision was 2 crore, excess provision was 20 lakh, that also has to be added back. So these were all the things. Then one more point you can write down, guys. This was asked in the MCQ. Here I'll write. So one is 2 other adjustments in MCQ. Excess provision. Second one, prior period expenses debited to P&L account. It is under Income Tax Act, it is grossly disallowed, not allowed, but hence it is here for MAT provisions, no need to add back, because it is not neither a reserve nor a any other provision that you are adding. It is not provision for the diminution in the value of assets, nothing. So no treatment, no need to add back. These are 2 MCQ areas which they were testing. So please note these 2 things, guys. Please note these 2 things. There used to be some tax planning concerning revaluation reserve. Tax planning using revaluation reserve. Check it out. So company had an asset valued 100 lakhs. It was sold during the year 31st March 2023 for, let us say, 2000 lakhs. What would be the profit? 1900 lakhs. Instead of this, what company was doing? So basically to the P&L account, what is coming? 1900 lakhs on which MAT has to be paid. Instead, what company was doing? Company used to revalue the asset. Revalue the asset. By how much? Let's say 1890 lakhs. The moment they revalue the asset, they used to obviously pass the entry asset account to revaluation reserve account. 1890, 1890. Then when they sell the asset, what will be the journal entry? Bank account 2000 to asset account. How much? 1990. Because 100 was already there, 100 plus 1890 is 1992. Profit is 10 lakh. And then what they used to do, revaluation reserve to general reserve, 1890, 1890. This was the tax planning that they were doing, my dear friends. To nullify this tax planning, here, clause number J was inserted. The amount standing in revaluation reserve relating to revalued asset on the retirement or disposal of such asset. Guys, on the retirement of disposal, anyway 10, but this 1890 is the amount which is there in the revaluation reserve account, that also has to be added. 1890 plus 10, basically reverse gear. 1900, you pay tax on 1900. Right? So that is regarding revaluation. Are you getting it, guys? Coolly, I'm explaining the logic of each and every point, becomes very simple. So we were discussing here, point number 10. Here. Amount in revaluation reserve on retirement of an asset, if not credited to P&L account. Have they credited to P&L account? No. Have they credited the same to P&L account? No. They have not credited. See here, where have they credited in this entire entry? Is it credited? No. P&L account not credited only. I told you, no, at the beginning. Clause number A to K, if debited to P&L account, add back. Clause number J, revaluation reserve, if not credited to P&L account, add back. So if you see the Bare Act, here nothing is given in J. Sorry, here J nothing is given, but here below, see here, any amount referred in clause J not credited to P&L account, add back. Are you getting my point? So clause number J is this, revaluation reserve. Revaluation reserve is not credited to P&L account due to this entire scheme or scam that they are doing. Hence, you have to add back. Revaluation reserve was not credited to P&L account. Hence, we have to add back. Hence, you have to add back. These three will do. Everything will do. This also requires examples. We'll see. Let's see the amounts credited, guys. Amounts credited here. As reduced by. As reduced by the amount withdrawn from any reserve or provision, excluding a reserve created before the first day of 1997 that you leave. The amount withdrawn from any reserves or provision, if any such amount is credited to P&L account. If any such amount is credited to P&L account. So just like we saw the debit side, reserve which is debited, if it's credited also, I am cleaning. So as reduced by In P&L account, manufacturing profit is 10 lakh. Transfer from reserve credited is 7 lakh. 7 lakh to be reduced. 7 lakh to be reduced. So how, why, what? So the company is making this much, 10 lakh and 17, totally 17 lakh. So let me take another example. Let me make it 5 lakh, 6 lakh, overall 11 lakh. How did they make this? Very simple. On manufacturing goods, they were making 5 lakh profit. On sale of investments, they are making 6 lakh profit. On sale of investments, they are making 6 lakh profit. Overall, it was 11 lakh profit. Profit on sale of investments was made on 36/2022. Assume company on 36/2022 passed an entry. What? Profit on sale of investments 6 lakh to reserve account 6 lakh. Then what they did? Reserve account 6 lakh to P&L account 6 lakh. Here P&L account 6 lakh. So is this as per schedule 13? Yes, very much as per schedule 13. So as per the statement of P&L account now, what will I do? Here net profit is coming up to 11 lakh. But then 11 minus 6, I'll have to subtract now obviously because it's there in the law. 11 minus 6, it is 5 lakh. 5 lakh. Mind you, this was 36/2022. Whereas profit and loss account here when I am making, it is 31st March 2022, 23, sorry. 31st March 2023. So now, so guys, same here, if you think about it, I am just directly subtracting it. Here nothing was added before, nothing was added now, nothing will be added in the future. See, I'll tell you, for example, this you see, you will understand. See, I had made provision for bad debts, 200 lakh. Provision for diminution in the value of assets, 250 lakh. So overall 450 lakh. As you know, provision for bad debts, diminution, etc. should be added back. Let's say this happened on 31st March 2019. Was it added back already? Yes. Basically that effect, tax effect has already been taken into. Today, on 31st March 22 today, you have credited the P&L account. Provision for bad debt not required anymore. Provision for diminution in the value of assets not required anymore. You have made it, let's say, 180 lakh and 120 lakh. This is not required anymore. Overall 300 lakh. This, since you have already added and paid tax on it, here subtracting it makes sense. This one, reserve, subtracting it makes sense. But if you have not at all added in this particular example, you see, I just did one scam. Profit on sale of investment transfer to reserve to P&L account. I did this 6 lakh. Have I charged this 6 lakh anytime before? No. So when I have not charged it to tax, or rather when I have not debited, whereby I have added it before, I have not disallowed it before, now I am subtracting it. So earlier also I did not pay MAT on the 6 lakhs. Now also, in fact, I am reducing it from the total net profit, which is scam. So though it's a very good provision, if where it was debited, you subtract, that makes sense. Whatever was debited before, if it's credited, then reduce, then it makes sense. But here, it just said like that. So lot of tax planning was happening, guys. So basically to nullify here. Where this section is applicable to an asset in any previous year, amount withdrawn from those assets created or provisions made shall not be reduced from book profit unless the book profit of such year has been increased by those reserves. Increased by those reserves. Which means what? Which year? Such year. Such year means which year? The year in which reserve or provision was made. So they are trying to tell, in that year, was a reserve or provision already made that year? No. In this example, was a reserve or provision made that year? No. If it was not made that year, if it was made that year, I will add back. And here I'll subtract, fair enough. Or in my example here, that year, was it made? Yes. Later on, will you subtract it? Yes, because I've already given the effect there, makes sense. But here, scam entries like this, intention of law is very simple. Scam entries like this, not allowed. So what do you mean by that year? Previous year in which the reserve or provision was made. Was 6 lakh added before? No. If it is not done so, nothing can be done. So in this example, was 6 lakh added? No. Where the section is applicable to in any previous year, the amount withdrawn from reserves created or provisions made in the previous year shall not be reduced from the book profit. 6 lakh will not be reduced if or unless the book profit of such year has been increased by those reserves out of which the said amount was withdrawn. So it should be a matching concept. Either under this explanation or explanation below the second proviso on 15J, your deemed income. Whatever the case may be, guys, very simple. Logically, you think if that year you have debited and you have added back, and again you have credited whatever is not needed, then you clean the balance sheet P&L. But doing scam entries like this, not allowed. Doing scam entries like that, absolutely not allowed, right? So this was the next provision, so to speak. See here. Amount withdrawn from any reserve if the same was created through P&L account. Simple words we have created. Amount withdrawn from any reserve, the same was created through P&L account. This you remember and go. Because if it was added before, now I'll allow you to subtract. It was not added before, not allow you to subtract. You write this only and go, no problem. Amount withdrawn from any reserve, the same was created through P&L account. Yes. Amount exempt under 10, 11, 12. So all these section 8 companies, then your agricultural income, all these things, that is the second point, guys. Income exempt under this shall be subtracted. So basically, if my expenditure is, let's say, 30 lakh, manufacturing is income is 50 lakh, agricultural income is 60 lakh, expenses from agricultural income is 20 lakh, Then we had seen here also expenditure relating to income under 10, 11, 12. That's why I have to do it together. Point number 6 here and point number 2 here. So basically what they are trying to tell here, 60 will be subtracted, 20 will be added. Basically you knock off these two is what they are trying to tell. Ultimately it will be this only. Ultimately it would be that only. So let's see the note here, note number 2. So guys, amount to which any of the incomes or expenditure under these three sections 10, 11, 12. Interesting to note that section 10AA is not covered under exempted income. So basically amount with which 10AA income etc. if you get, it will not be subtracted. Similarly important again, ATIA, ATIB will not be subtracted. So basically foreigners, I enticed the foreigners to come to India and told them under ATIA for 10 assessment years everything is free and all that. But later MAT was introduced and they said you have to pay tax 15%. They said this is cheating. Chidambaram said, sorry bro, sorry, but no choice. That's why Nirmala madam came and she introduced 115 BA, BAB saying that if you follow that, MAT will not come. Remember, if you follow that, MAT will not come. Try to follow. There I'll give you ATIA also. All that. Little bit, level playing field was created. But ultimately, basically ATIA is subject to MAT. Means they have to pay MAT. Got it? Yes. So guys, 10AA is not exempt. ATIA not exempt. ATIB etc. Full ATIA series not exempt. Please note. It's easy guys, MAT is very easy. So now, continuing this, if company is a partner in a firm, his share of profit, that is company share of profit, is exempt under section 10. 10(2)(a) especially, right? So since it is exempt under 10(2)(a), that share that a company is receiving, in the company the share that it receives from any partnership firm, that would be deducted. Because if you see here, income exempt under 10, 11, 12 are exempt. I mean, should be deducted. They're deducted. But if the same company happens to be a member of AOP, share is exempt because AOP pays, if you remember guys, taxation of AOP, please recall, taxation of AOP, AOP pays MMR. Since AOP pays maximum marginal rate, the share of such profit from the AOP or share of income etc. is exempt under section 86 and not section 10. So basically in the balance sheet and in the P&L account, if I receive any share from AOP, this is under section 86 exempt. But if you see in this provision, only income exempt under section 10, 11, 12 should be deducted, which means this was not allowed to be deducted only because this is a AOP and this is a firm. If one is a firm, no problem. One is AOP, problem. They said cheating, cheating. So Chidambaram said, okay bro, I will change it. See now? Here. Separate point he added. Share from AOP BOI not chargeable to tax. Share from AOP BOI not chargeable to tax. Similarly, expenses related to AOP BOI to be added. Very easy, guys. Chiller. Point number 1, income tax payable, provision for income tax, interest. Point number 2, transfer to reserves. Provision for unascertained liabilities, dividend paid or proposed. Losses for subsidiary companies add back. Income exempt under 1011 add back. AOP add back. Deferred tax, provision for deferred tax add back. Provision for diminution in the value of asset, that is provision for bad debts add back. Amount in revaluation reserve on retirement if not credited to P&L account add back. And subtractions, amount withdrawn from any reserve subtract. Income exempt under 1011 subtract. Share from AOP BOI subtract. Got it? Now, let's check. Depreciation. P&L account as on 31st March 23. Expenses 40 lakh. Depreciation 25 lakh. Net profit here. Sales 200 lakh. Net profit 135 lakh. 200 tally. Now, company revalues assets by 300 lakh. Depreciation rate, let's say, is 15%. So what I'll do, this again was done by Ambani. Case number 1, case number 2, case number 3. Case number 1, P&L account. Expenses will be 40 lakh only. Depreciation 15% on 300 lakh. 25 lakh is already there. 15% 45. 45 plus 25 70 lakh. So here depreciation I will show 70 lakh. And sales I will show 200 lakh. Then amount withdrawn from what? Revaluation reserve I will show 45 lakh. Net profit I will show 135 lakh. Right? This is what scam they were doing. $245. So this is what they were scam that they were doing. When they were doing this scam, what will happen? right? When they were doing the scam, what will happen? Nothing will happen. Basically, I will take it as what? Here, I don't want to pay 135. So what I will do? I will claim more depreciation. And I'll say, I have not done anything. I've just, done all these things in a nice way. So I will make 200 minus 45 minus 40 minus 70, reorganizing everything. In depreciation, I will claim higher. There is one scam. So I would reduce this also. Here anyway, if you see 200 lakh was there. 200 minus 40 minus 25. To that 135, I had to add 25 lakhs. Depreciation has to be added back. Right? Why? I'll tell you. So this is a combined reading of 3 sections. Clause 2A, 2B, and one more clause with respect to depreciation. So this scam they were doing. Case number 2 scam. Everything is nullified, guys, don't worry. Case number 2 scam. Sales 200 lakh. Expenses 40 lakh. Depreciation 70 lakh. Net profit 90 lakh. This was one more scam. In this, that 45 lakh they transferred to revaluation reserve account 45 lakh to general reserve account 45 lakh. In the third case, everything is the same, but assume expenses was 48 lakh. Thereby, your net profit, because of various things, net profit is also 138 lakh. Assumption. So now, guys, what does it say? Check it out. Three things. The law says all these scams, whatever you do, I will not allow. Everything will be completely nullified. How? Check it out. First, what we should do, see here. Add back the total depreciation. See, whatever depreciation you are charged, add back. Full depreciation should be added at any cost. Next, less. Here. Depreciation excluding the depreciation on revaluation of the asset. As an example on depreciation, we'll see. Depreciation excluding the depreciation on revaluation of the asset. And next, amount withdrawn from revaluation reserve and credited to P&L account to the extent it does not exceed the amount of depreciation on account of revaluation. One is what? Amount withdrawn from the revaluation reserve. One more, depreciation excluding depreciation on revaluation of asset. You see, and first add back the depreciation. So, let's see. Case number 1. What should I do? Net profit is 135 lakh. Add back the depreciation of 70 lakh. Less. Depreciation on account of depreciation excluding the depreciation on revaluation. So, revaluation, because of revaluation, it has increased by 45, but what was originally 25 lakhs. So, I should subtract what? 25 lakhs. Next, amount transferred from revaluation reserve to the extent of depreciation. See, amount withdrawn from revaluation reserve and credited to P&L account to the extent it does not exceed the amount of depreciation. That we'll see. So, basically 45. So, my depreciation 45 lakhs. Same it comes to 135 lakh itself, which you would have paid anyway here. Status quo. Reverse gear. Here you see. Here. Net profit 90 lakh. Add back full depreciation 70 lakh. Subtract depreciation, which is excluding the depreciation out on account of revaluation, that is 25 lakh. Other one was what? Amount withdrawn from revaluation reserve and credited to P&L. Is anything credited to P&L here? No. So nothing to be subtracted. So if you do this also, 90 plus 70 minus 25 is also 135 lakh. Same, no change. I will pay on 135 only. You cannot show less here 90, 135 only. On the other hand, you see, if the net profit was 138 lakhs, 138 plus add back depreciation 70 lakh. Minus how much, guys? Depreciation claimed as per the, without revaluation. Next. What is the amount withdrawn? I told you. Sorry, my bad, guys. Not expenses, not expenses. This one. Sorry. Not expenses. Amount withdrawn. Amount withdrawn from revaluation reserve account was 48 lakhs. You see. Total depreciation was 70, which is the same. 25 lakh is depreciation without revaluation. Because of revaluation, that extra is 45 lakhs. Overall is 70 lakhs. I am saying the amount that you have withdrawn, instead of 45 lakhs, you have withdrawn 48 lakhs. You can withdraw any amount you want. So here they have withdrawn 48 lakhs. The question is, when I am subtracting here, should I subtract 48 lakh or should I subtract 45 lakh? That was the question. See the wordings. Amount withdrawn from revaluation reserve and credited to P&L account, that is 48 lakhs is actually withdrawn as per my example. To the extent it does not exceed the amount of depreciation on account of revaluation. What is the amount of depreciation on account of revaluation? 45. So maximum you can withdraw is just 45 lakhs, or rather you can subtract maximum is 45 lakhs and not 48 lakh is what I am saying. So similar example, see this one is there. So you can check this out. Same, you will understand this. Do this example, guys. Go through this, you will understand. Whatever I did, different example, you do this. Simple. To the extent of, you will get it. Read it, okay? Do similar example. Please solve it on your own. It's easy. Yes, next. Solve this one. This point. Note number 3. We'll see this. With the adjustment, I'll just read the bare act now for you. Point number 7, guys. Check it out. Clause 3, it will come under this one. The amount of loss brought forward or unabsorbed depreciation, whichever is less as per the books of accounts. In case of a company other than the company referred to in 2H. We'll see 2H later. So loss before depreciation 3 lakh. Depreciation itself is 8 lakh. Total loss after depreciation is 11 lakh. So how much should be subtracted? That says that the total amount of loss brought forward or unabsorbed depreciation, whichever is less. So people are asking, should it be 8 lakh, 11 lakh, whichever is less, 8 lakh, or should it be 3 lakh or 8 lakh, whichever is less, 3 lakh? Litigation happened. When I say loss, is it loss before depreciation or total loss? Unabsorbed depreciation is 8 lakh. So unabsorbed depreciation 8 lakh or loss, whichever is lesser. Loss, should it be 11 lakh or 3 lakh? Should I take 8 lakh or 3 lakh, whichever is lesser? That's what the question was. So they added an explanation. Here, loss shall not include depreciation. And the provisions of this clause shall not apply if the amount of loss brought forward or unabsorbed depreciation is nil. So here, loss will not include depreciation. So basically, guys, it will not be 11 lakh. It's 3 lakh or 8 lakh, whichever is less, 3 lakh. See here. Business loss 12 lakhs, unabsorbed depreciation 17 lakh. So basically it is what? 12 or 17, whichever is less. Business loss 5, unabsorbed is nil. So that also says if it is nil, it should be taken as nil. Whichever is less is nil only, no? Business loss is nil, unabsorbed is 14, so it will be taken as nil. It is not business loss and unabsorbed depreciation 27 lakhs loss, 29 lakhs loss, no. On the other hand, guys, business loss and unabsorbed depreciation both will be allowed as reduction, means both will be reduced if the company and its subsidiary or subsidiary of the company, basically that entire holding company with subsidiary 1, subsidiary 2, the entire thing has gone under 241 and 242. This is compromise and arrangement under Companies Act. Under compromise and arrangement, what will happen is, I will go to the tribunal. I'm sorry, not compromise arrangement, it is oppression and mismanagement. 241 and 242 is oppression and mismanagement, whereby the shareholders will go and seek the help of the tribunal, National Company Law Tribunal, telling that, sir, the company is going through mismanagement and there's a lot of oppression. So please throw out the directors and appoint new directors in their place. Company is already going down, so directors also have committed some fraud, etc. So the National Company Law Tribunal will come and appoint new directors. This happened in Mahendra Satyam case when Ramalinga Raju, Satyam case, when Ramalinga Raju went and told, I committed fraud. Immediately, government told the NCLT, and NCLT appointed directors under this section of the relevant old Act 1956. So that be the case for MAT. First of all, the company is going under loss. If I just subtract depreciation or unabsorbed or loss, it will be a problem. So they said both you can subtract, no problem. Second, if the company is going through IBC, Insolvency and Bankruptcy Code, they have applied for something called as CIRP, Corporate Insolvency Resolution Process. That be the case. In both these cases, what will be allowed, guys? Business loss as well as unabsorbed depreciation. So here, and the company is got under exception. So what? 12 plus 17, 29. 5 plus 0, 5. 0 plus 14, 14. Hope you got this point. This is the extra benefit that is there. Got it. Cool. Got it? Done. So guys, now abruptly I'll change the topic. Why? You will definitely know why. See 13.1. Because to do something in MAT, We need to understand this. Okay. 115 BBF. 116 BBF. So 115 BBF is tax on income from patents. So in this case, where the total income of an eligible SSE, who's an eligible SSE? Guys, patents, obviously for Make in India concept, more and more people who are resident in India, who make anything which is sold across the world, patented, then whatever money is getting, rather than paying the normal rates, concessional rate is given under 115 BBF. Check it out. Eligible SSE would mean a person resident in India who is in true and the first inventor of the invention and whose name is entered on the patent register as the patentee. Where the total income of an eligible SSE includes any income by way of royalty in respect of a patent developed and registered in India. Developed means what? 75% of the expenditure should be incurred in India by the eligible SSE as per the Patent Act. So basically, Make in India benefit. What benefit will I give? So guys, if you opt for it, where an eligible SSE in respect of any previous year opts for what? 115 BBF. Opts for 115 BBF. If the SSE offers the income, royalty or for taxation not in accordance with this section for any of the 5 consecutive years, then the SSE would not be eligible to opt for concessional rate for 5 years subsequent. So basically there's a lock-in. So if you do not do in accordance for 5 consecutive assessment years, then you will not be eligible for 5 assessment years subsequent. That you leave. But what is the rate? Rate is very simple. 10% on such income. No PGBP, normal slab rate, 30, 40, 35% surcharge, nothing on that. Make in India concept, new section 115 BBF. Deduction of any expense from the royalty income is obviously not allowed. Direct, whatever is income into 10%. You can opt for the concessional rate, and to exercise the option, you should do it on or before due date of filing the return of income. If you don't do it, then for any of the 5 assessment years in once also, if you miss out by doing this, if you are not opting it on time, and if you break the rules as laid down for this section, then you will not get this concessional rate for 5 more years. From the year, it will be considered as opt-out, and from that opt-out scheme, 5 years you will not get. But guys, interesting to know that you will also get deduction under 3 lakh of under 80 RRB. That also you will get deduction, so no tension. Even if opted for 115 BA, then also it is 10%. Mind you, important to note, and not 22%. If you opt for that 115 BA individual, no MAT also. No MAT also. This is why we discussed. Now you come here, you will understand. Understood this point? 13.1. Now you come to our MAT provisions. Why this fellow went off to this provision, you will be wondering, because of this only. See here. Here. Expenditure relating to royalty, income, taxable under 115 BBF, add back for a company. Here when I said 115 BA, it is the 22% for domestic companies lesser rate. Since MAT is there, I told individual, sorry, that is 115 BAB, that is different. I'm talking about BA. BA is for companies. Remember the reduced tax rate 22%. So there also MAT will not be there, because MAT is only applicable for companies. So if you see here guys, I told individual, don't get confused. 115 BA is for companies. So if you see, slip of tongue, my bad, sorry. Expenditure relating to royalty income of patent taxable under section 115 BBF. So this is to be added back. Similarly here, income by way of royalty on patent taxable under 115 BBF, subtract. To be subtracted. Very simple. Foreign company started crying. Foreign company started crying, saying that, boss, you are not giving me any benefit. You told me everything is free, now you are charging MAT. They had certain problems. They said, if you remember, revision in capital gains you had done, 112A. If it is long-term capital gain on shares where STT is paid, generally I'll pay 10%. So if it is again LTCG on zero coupon bonds and listed units, again it is 10%. In case of royalty, fee for technical services under 115A of income tax, we have seen international taxation, it is 10%. Certain interest incomes as per 194 LC and LB taxed at 5%. Dividend income under 115 AC 10%. All that you are charging 10%, and now MAT you are stamping me 15%. How is it fair? Do something, bro. They begged. For that begging, this provision came. In case of foreign income, they told if you are earning capital gain, interest, dividend, royalty, etc., the percentage, if it is less than 15%, like this, percentage is less than 15%, all these cases, do not worry, MAT will not apply. All the expenses you add back, all the incomes you subtract. Simple. So that these will be taxed separately at that 15%, whatever, 10, 5, whatever it is. I'll tax there only, don't worry. But let's clean the P&L account. Let's clean the P&L account. So if you see, in case of foreign company, expenditure relating to capital gains arising on transaction in securities or interest, dividend, royalty, fee for technical services chargeable under special rates discussed. Similarly here, in case of foreign company, income relating to capital gains, interest, dividend, royalty, fee for technical service chargeable to tax under special rates. Only if income is taxable under the general provisions of the Act is at a rate lesser than MAT. These examples. If these rates are lesser than MAT, then only for foreign company only, guys, mind you, foreign company relaxation given because they were crying. Foreign company relaxation was given. Understood? Guys, the previous session we did business trust, if you remember. That's why, guys, everything is in a proper sequence so that you will have no tension. If you remember, we did international taxation and then we came to this because international taxation, did we see any of these things, MAT and all? We just did foreign trade a little bit, but then MAT really was not needed in international taxation. So we completed all the major areas, small areas we're doing. But this area also, like business trust also, questions will come. MAT Pakka questions will come. So we are doing everything together in a proper sequence. I hope you are able to appreciate it. Sir, forget about appreciating. I hope you are able to understand. Now you see. Remember, guys, business trust, how it works. Unit holders, REIT, will issue units to the business trust. Exchange of shares in return for the units. And this would be a company. I gave a mall example, special purpose vehicle. And that will be transferred to this business trust, real estate investment trust. We had seen that. So anything for that matter. So we had seen it. So I had given you that Rajini example. So basically, create will give units in exchange for shares. Let's say this is Rajini Boss Limited. Rajini Boss Limited held shares in Rajini Limited. 100%. And Rajini Boss Limited gave all the shares to REIT and REIT issued units. As we discussed, when it issues units, for them, no tax under 47(17). When allotted, no tax. But when Rajini Boss Limited sells these units, then the capital gain will arise. This is as per Income Tax Act. But as far as MAT is concerned, they will be making some money here. For example, if the unit was initially purchased by Rajini Boss at, the shares was initially purchased at 100 rupees. Now the unit value for that, whatever you are getting, is 1000 rupees. Think about it. What is the capital gain? 900 rupees per share or per unit, whatever it is. This is not taxable at the time of conversion. But if this 1000 rupees is sold at 2500 rupees later, we have discussed what is the cost of acquisition? 1000. Or is it 100? Remember? What would be the cost of acquisition? Cost would be whatever its cost was there. That is basically you should always take in capital gain only we have seen, guys, if I give a building and take gold in return, what would be the sale consideration? FMV of the gold. And what would be the cost in the future? Same thing. So if you see, I'm just asking 1000 units, value, 1000 was units was given in place of shares purchased at 100. There was a notional gain of 900 here. Similarly, this 1000 was sold at 2500. There was a gain of 1500 here. But technically, the overall gain is 2500 minus 100. That is 2400. That is 1500 minus 900. The problem is some assessing officers where though the capital gain was exempt here, the profit when you are recording, so this will be 2018, this will be 2020, this will be 2023. As per Income Tax Act, capital gain will arise only here. There is no doubt about it, because this is exempt. But for MAT provisions, will I pay tax on 900 in 2020 was the question. Or will I pay tax on 2400 in 2023 was one more question. Or should I only pay on 1500 is a third question. Full confusion. Right? So we are going to discuss here. Amount representing notional gain on transfer of shares of SPV to a business trust in exchange of units allowed by trust. In my example, this is notional gain on transfer of shares 900. Notional gain resulting from any change in the carrying amount of such units. Actual gain on transfer of units of business trust. Loss on transfer of units of business trust. So if you see, there is an example here, but better example, we'll do a more in-depth example, no problem. Let's see. Whatever I do know, the ulta, this is notional gain. Notional loss is here, obviously reverse. That is also covered. Same. Reverse. Once we understand this, the reverse will be that. Nothing to understand in that. Let's see, guys. So this will create an example. Illustration on notional gain of what? Business trust. First one. Manufacturing profit. 500 lakhs. An examination modified question this is. That's why I'm doing it here. Not even an examination. It's somewhere in MTP or RTP. In exam it is still not come. Cost of shares of SPV in India. Shareholder. Shareholder is a company. Only then Matt will come, no? Rajni Boss Limited has acquired Rajni Limited. And Rajni Limited is the SPV. Rajni Boss Limited is the shareholder who's the sponsor. That sponsor now is giving away the shares to REIT, and REIT is issuing units. I hope the entire thing is clear for you. Now this is 1000 lakhs. Third, shares transferred. Units allotted. Face value 120 lakh units at 10 each. 1200 lakhs. But market value 11 rupees per unit. Units sold 31/3/2021. This one happened on 1/1/2020. Cost of shares 1/1/2014. So 14, 20, 21. Sold at 20 rupees per unit. So how many units given? 120 lakh units into 20. So 2400 lakhs. So as per ICDS, when a security A is exchanged with security B, I should record it at FMB. This is what we saw in capital gain also. Should be recorded as at FMB only. So here, what are the units in business trust? What are the units of business trust here? What is the units that I have purchased? $120 lakh into 11. I will use it as FM. FM is 11 rupees. So units of business trust that are 120 lakh into 11. 1320 lakhs. 2. Shares in SPV account. How much is the shares, guys? Cost 1000 lakh. Now, what is the notional gain? Profit on sale of shares 320. This is what the law says CG is exempt. Has it been realized now? No, just on conversion. Book entry I'm writing. This 320 will include two things. One is what? 120 into 1 rupee notional gain. 120 lakhs market value. Remember, in one more is what? The other one is what? On exchange of shares. So basically 120 remove from here. 120 is just an extra thing. So remaining is what? 1200 minus 100. So 200 lakh is actual profit on exchange of shares. Obviously, no. 120 is just a notional profit at 1 rupee extra. Notional gain. Because I am recording the units at FMB, notional gain. 200 lakh is what? The actual profit that you make. But both are not yet realized, mind you. Next, at the time of sale in 2021, bank account. How much? 2,400 crore. 2 units of business trust. This will go 1,320. And 2 profit. How much profit I'll make? 1080. For income tax purposes, cost of these units will be taken to be cost of the shares for income tax purposes. Holding period will be whatever was held by the previous guy. That is that company, that only will be taken. So for income tax purposes, holding period will be 1/1/2014 to 30th March 2021. Here 1/1/2014 to 30th March. Period of holding should be 1 day before always. Remember, 30th March 2021. Cost of acquisition will be taken as 1000 lakhs. LTCG will be on how much? 1,400 lakhs. 2,400 minus 1,000 at 10%. STT is paid 10% under 1112A. This is the entire scheme of things. Company has manufacturing profit of 500 lakhs also. Manufacturing profit is 500 lakhs. And what is the profit on sale of units, guys? Here 1080 lakhs. Are you getting it, guys? Coolly, I have written all the entries. Go through it again. You see now here. this A and B, no, this will be year 1. What is year 1? Allotment of units in exchange of shares. That I have to subtract. This one, C. This will be the year of sale. When those units are sold, this has to be taken into account. How it works, you see how it works. Very simple. What used to happen? For example, year 1 you take, year 1. Year 1, manufacturing profit is already 500. I've already taken into account. And what is the notional gain that the company is profit on sale of shares here? This one, 320. This one. This also happens in year 1. So in year 1, 320 also will come. This 320 is split into 200 and 120. Overall, guys, the MAT would have come to 820. Total income for MAT would have come to 820. This only is a net profit, 820. This is wrong, right? Because it should only come in capital gains, it is exempt, but here it's not exempt. So what are they trying to tell? From this income, you reduce these two. Now you read. Notional gain on transfer of shares of SPV to a business trust in exchange of units allotted by trust. 200. Notional gain resulting from change in the carrying amount. 120. 10 rupees to 11 rupees. 120. So they are trying to tell in this particular year. In this particular year, if 820 is the net profit, subtract 200, subtract 120. See the next point here. The other point will it come, you see. Actual gain on transfer of units. Has the units been transferred? No. Actual gain, when it happens? Later. So here, minus nil will come. Does not happen. So overall, how much, guys? Ultimately, I am paying on 500 only. I am paying on 500 only, no change. I am paying on 500, no change. Right? You see book profit, what will it be for the year of sale? This is the book profit. You get 2,400 crore. Units of was 1320 and profit was 1080. On the year of sale, I assume manufacturing profit to be 500 lakhs or whatever. Then profit on sale of units is 1080. Overall, how much? 1580 profit. Now from this I have to subtract certain things. What should I do? Check it out. First and foremost, guys, net profit as per profit and loss account 1580. To this I need to add, see here, this part. Here, gain on transfer of units of the business trust. Gain on transfer of units of the business trust means what? What is the gain, guys? We have done the capital gain already here. See, gain, selling price 2,400 minus cost is 1,000, gain is 1,400. So add gain 1,400 less. What should I subtract? One is this part. What should I subtract? These two. Notional gain on transfer of shares of SPV to a business trust in exchange of units allotted by trust. Notional gain resulting from change in carrying amount of such units. 200 plus 120. Will it come here or it has already come? It has already come. So here it will not come. Second. Gain 1400. Less what? Notional gain. $300 has already been taken here, guys. 200 and 120 already taken here. So here will not be taken. But here I told you one more subtraction is there here. Come back. Here one more subtraction is there. Actual gain on transfer of, sorry, not this. Sorry, here only, sir. Actual gain on transfer of units. So what is the actual gain on transfer of units? Not the notional gain, actual gain. That is this profit. 1080. So if you see overall it comes up to 1900. So the book profit will be 1900. Guys, very simple, nothing to worry. You just take the net profit as per P&L account, add as per clause K, that is the gain. That is whatever CG was exempt. Capital gain which is exempt, that you have to add. Less notional gain. Less actual gain. This actual gain will come in the year of sale. This gain, wherever CG was exempt, this also will come in the year of sale. Whereas this one will come under in year number 1. Now you see, net profit 820. This is in the year 1. Plus gain, capital gain which is exempt. That should not be added anything. Minus notional gain, because it's already credited here, no? Notional gain 200. One more notional gain because of FMB 120. Minus, so that's what I told you here, year 1. Actual gain. In that year 1, is there any actual gain? No. So overall 500. Basically, instead of 820, I am paying on 500 only. Point number 1. Point number 2 is in the year of transfer, P&L account is 1580. I will add the gain, overall gain that capital gain that I have to pay, which is actually exempt. Which actually was exempt, right? Which actually was exempt. Now I have to pay, no? This actual gain, 2400 minus 1000. 1000 was the cost, 2400 was the selling price that I have to add. Here you can write what was exempt before. What was exempt. So here also 820 plus nothing was exempt that time. Minus notional gain, minus this thing, minus nil, 500. Here 1580. Add the actual, the gain that you got now, 2400 minus 1000, 1400. Subtract the notional gain, nothing to subtract, already subtracted before, and actual gain. Actual gain is 1080. Here, if you see, actual gain is 1080. Why? Because the unit was recorded at 1320. So books, actual gain in the books is just 1080. So that I have to subtract. So guys, basically this was the gain as per income tax, 2400 minus 1000. This is the gain as per actual gain as per the books. So that differential only, which I did not tax here, 820 minus 500, 320 I did not tax there, but I am taxing it here. See the difference? It is coming up to 320 only. That is all the logic is, very simple. Simply it looks very complicated, but what was not taxed back then is taxed now. That's it. So P&L account book profit is different. So that book profit I will take. To that I will add the current gain as per Income Tax Act. Subtract the notional gain which was taken into consideration before. I have already subtracted it. I will no need to subtract here again. I have already subtracted before. Plus the actual gain as per the books of accounts. Actual gain of the books of accounts is this only, 1320, which I have recorded it, and 2400 crore, 1080. Ultimately the difference between the two, 1400 and 1080, is anyway 320, which I have to pay now. Basically earlier instead of 820 I paid on 500. 320 was still pending. So now I am paying 320 extra. That's all there is to it. 1580 is the net profit, book profit, plus 320 what I did not pay before, overall coming up to 1900. They are showing it like this. That's all. This is just the difference between 1400 and 1080. Clear, guys? That's all there is to it. Check out. Same. No need to get confused. It's quite simple. Reverse of that will be loss. If it's a loss, totally you do the reverse. That's it. Then amount of profits of SIC Industrial Companies Act. That after IBC has come, this is useless. So all the profits of SIC Industrial Companies Act we should subtract, and because for that it goes into a concept called BIFR, Board for Industrial and Financial Reconstruction. That's why all the profits of SIC Industrial Companies Act should be subtracted. No MAT on that. Special exemption for that. Very simple. So if the apart from that, let's see. AS Ind AS compliant later we'll do, guys. The next class we'll do. Some additional points here. Page S6. All other provisions of income tax shall be applicable to every company mentioned in 115 JB. So earlier, there was total income was there of, let's say, 10 crore, book minus 10 crore loss. Book profit was there of 3 crores. Since they used the word notwithstanding, they said no carry forward, nothing will apply. Tax should be paid on 3 crore, but no carry forward will apply. So many decisions were bad. It was nullified through various provisions. This is nothing but 115 JB 3, 4, 5 and all those things, all these points. All other, when I use the word notwithstanding anything contained, it only overrides the conflicting provisions. It doesn't override the entire act. So all other provisions of Income Tax Act shall equally be applicable to every company mentioned in section 115 JB. Levy of interest under 234A, B and C on account of violation of provision should be levied in respect of tax computed under book profit also. Company to which MAT applies shall be liable to pay advance tax, interest under 234A, B, C, penalty for misreporting, everything will apply. Similarly, determination of amounts in relation to relevant previous year to be carried forward, subsequent years, all this will apply, shall not be affected. Basically, carry forward you know, it is 8 years here, correct? 8 years as per Income Tax Act. But here there is no such provision. So does it mean it overrides the carried forward also? No, nothing like that. Every company to which the provisions of 115 JB are applicable shall furnish a report in 29B from a CA. Where accumulated, this what? When accumulated business loss and unobserved depreciation pertains to more than 1 year, CBDT has clarified that comparison between the two has to be made on cumulative figures and not year on year. So if you see, company has furnished the following business loss, unobserved depreciation. Should I do this, compare each of these things, or should I do overall? It says overall. 18 lakh of unobserved depreciation shall be allowed to be reduced from net profits to compute book profits. So what is allowed? Business loss or unobserved depreciation, whichever is less, right? So here I should compute on an overall basis. This is an examination question also in May, if I'm not wrong, 18. I'm not sure about the year, but once or twice they have asked this question. It is always to be done on overall basis. Always to be done on overall basis. So there were many cases, Apollo Tires, Malayalam Manorama, in all these cases they said that assessing officer cannot have the right to touch the books of accounts that you have already prepared. Once you have prepared the books of accounts, you cannot go and pass an inquiry into the books of accounts like that. Whatever is there, it has to be blindly accepted. See, here is given. The AO cannot recompute profit once the financial statement are approved in the general meeting. Adjustments can be made only to the extent permitted under 115 JB. Then prior period expenses cannot be added back, already discussed. Provision for tax made by foreign branches are to be added back to net profits at arriving at book value. There is no difference between Indian income tax and foreign income tax. It should be added back. Lease equalization account was not in the nature of reserve and need to be added back. It is not in the nature of reserve and it need not be added back. Sorry. It's called lease equalization account, need not be added back. While calculating the total income under the income tax, required to take into account any capital gains under section 45. Capital gains reflected in the statement of profit and loss account will be part of the book profits. Capital gains exempted under 54 to 55 shall be reduced in normal computation, but not in computation of book profits. Obviously, guys, because I should take any capital accounts under capital gains under 45. If it claimed exemption, it is only for income tax purposes, not for MAT purposes. And here, provision for gratuity disallowed. Actual valuation considered not to be added back in terms of MAT provisions. Provision for bonus leave encashment allowed as per 143B, not to be added back. Bad debts allowed under 3617, not to be added back. Provision for bad and doubtful debts disallowed, here also added back. Expenses subject to 40A and 40 disallowed, here not to be added back. So these are some of the hidden points. Remember these and go. So Dhirubhai Ambani took up this guy's challenge, or Lungi man's challenge, and he did one thing whereby, what do you say? He went to the shareholders and said, I am charging arrears of depreciation from 1974, whenever Reliance started, till today, 10,000 crore. And net profit will be 10,300 crore. Then transferred from general reserve, 10,000 crore. Depreciation, he charged arrears of depreciation, transferred it to general reserve. So when he was computing book profit, net profit 10,300 crore minus general reserve 10,000 crore. He just paid on 300 crore and washed his hands. Because arrears of depreciation, should it be added back or not? Nothing. There is no such provision on arrears of depreciation, guys. No need to add back. Only depreciation has to be added back fully, not arrears of depreciation. This went to the court, he won the case also. So, Dhirubhai Ambani was always one step ahead of the government. Always one step ahead of the government. Last part of the story, MAT credit. Other things we'll see later. Excess tax paid under 115 JB over normal provisions, they should be read as MAT credit. So here I have paid 10 crore, normal provisions 8 crore. So 2 crore will be MAT credit. MAT credit can be carried forward for 15 years immediately succeeding the assessment year. MAT credit can be set off when the tax computed under normal provisions for income tax is in excess of MAT. We'll see an example. In case of domestic company which exercises the option of special rate under 115 BAB or BAA, provisions of MAT are not available. Accordingly, set off unutilized MAT credit is not applicable for such entities. I told you 115 BAB MAT is not applicable. No interest is payable to the company on MAT credit available. The amount of tax payable is reduced or increased as a result of an order. MAT credit also shall be increased or decreased accordingly. On conversion of private company or unlisted public company into LLP, MAT credit shall not be available. Does not have the choice not to avail set off or defer set off. You cannot say next year we will see nothing doing. If it is in excess, you can take credit and next year it has to set it off. Examples. Tax on normal 6 lakh, MAT 10 lakhs. Tax payable, whichever is higher, 10 lakhs. So do you get credit 10 minus 4? Yes. 4 lakhs. Actually paid 10 lakhs. Balance credit 4 lakhs. Next year, 8 lakhs is normal income, 5 lakhs is MAT credit. MAT. What will you pay? 8. What is MAT credit? Normal, you have paid how much? You see here. Excess tax paid under section 115 JB over normal provisions of income tax. So see guys, if MAT amount paid is more, you will get credit. Here number 1. 10 out of 6, what will you pay? 10. So you will pay 10. Instead of 6, you will pay 10. So 4 lakhs you will get credit, which will be carried forward. Next year. 8 and 5. How much you should pay? 8 you will pay. But as per MAT it is 5. Last year you have credit 4. How much will you actually pay? I'll only pay 5. No problem. Because I have credit. Last year 4 I have paid more. Out of this 4 I will take 3 lakhs this year. 5 plus 3. How much will I pay? 1 balance. Next year. 3 lakhs is this 5.5. So 5.5 I am taking. I have to pay 5.5. So I am paying extra 2.5. That will be the credit. How much is the entire amount paid? 5.5. So 2.5 plus 1, 3.5 will be the credit. Next. 15 lakh, 20 lakh. How much should I pay? 20 lakh. How much is the credit will I get? 5 lakh. Actually paid 20. So 5 plus 3.5, 8.5. Next year. 12 lakhs and 2 lakhs. How much is payable? 12 lakhs. But guys, I will take the full amount 8.5 lakhs as credit. I will utilize MAT credit utilization. So I should pay 12 lakhs, but I will take the credit of 8.5 lakhs. What is the balance tax actual payable? 3.5 lakhs. Very simple. FTC, if you remember, we have done it in international taxation, where a company is entitled to foreign tax credit under 1998 and is allowed against MAT. If FTC exceeds FTC admissible against tax payable under normal provisions, FTC shall be ignored in computing the MAT credit. Tax paid in foreign country amounts to 40,000, for which tax credit can be claimed in India against MAT payable. Tax liability of the company as per normal provisions is 35,000 and as per MAT is 50,000. In this case, FTC credit shall be allowed against MAT. That is 50k minus 40k, 10k. Similarly, FTC against tax as per normal provision is in excess of such tax by 5,000. 35,000 minus 40,000, it shall be ignored. MAT credit is 10,000. Refer international tax discussion. We have done this fully there. Foreign tax credit. So the other part of it, small areas, we will finish off tomorrow and continue with other areas. Okay. Very easy, guys. Math 2.5 hours we have discussed in depth. Everything we have covered. Please go through everything. Single point we have not left anything. Okay. Please go through. See you. Come on. Up top. Awesome.